The opinions and recommendations expressed by Dan are his own and do not necessarily represent the opinions of this station or any of the show's sponsors.
Well, I didn't even talk about the indices yesterday. Of course, they were way up, record territory, likely to be in record territory today at some point in time, although it's very, very interesting to see them move downward. The futures were all in positive territory. But here's what I said earlier, and the Dow's down 4. But here's what I said earlier. Can we now, since the Fed has lost all this credibility on Wall Street, could it be that Wall Street, companies, analysts, investors, hedge fund managers, mutual fund managers are going to do the unthinkable for the last 5 years and do what I've been doing and continue to do and turn their eyes and their analytical work towards the economy, not the fundamentals of the market, but the economy? Did Ben Bernanke do an incredible service to America that was totally unintended by pointing out some of the factors in the economy that need to get better and aren't doing as well as we all thought? Because we were all consumed, not we, I don't want to count myself in that we were consumed in the economy. In the markets. And now they're turning to the economy. And if they start doing some real analytical work on our debt, on the economy, I'll give it to them. If you're listening out there, if you're an analyst and you want some of, I'll share my thoughts and my data. It's not hard to figure out that the fundamentals of the economy are pathetic. And I think it's even more deceiving to call what we are in today a recovery. I said that the day the recovery started, I said it was a joke. It's still a joke. You cannot have a recovery with the economic conditions the way it is today. It is virtually impossible. It has never happened in the history of this nation. It has never happened in the history of any recovery, including the Depression. When we come out of those things, there are certain things that must happen, that always happen. We must have robust job growth. We must see the poverty level coming down. We must see the level, at least in the last 3 recessions, the level of food stamps coming down, not going up. Disability benefits going down, not going up. Median incomes rising, not going down. Labor participation rate getting higher, not getting lower. Do you understand that if this is a recovery, it's a recovery out of the twilight zone? It's a recovery to the likes of which we've never seen. 866-300-9298. Russ, if you're still listening, from Texas, here's what you need to consider. I would definitely move your 401k. The reason I say that, and when I say move it, I mean roll it over into an IRA so that you have some control over it, so that you can get it in a money market account. You sound like somebody that's concerned about the preservation of it based on what we're going through, and that's reasonable, and you should be. Then you ought to move it. But the reason I'm going to assume you're retired and you have adequate income to at least pay your mortgage, right? And so you must have some decent income, maybe a pension, Social Security and pension, and you're doing okay. The only way I don't have a problem paying all the tax on this 401k and using it to pay your debt on your mortgage, the only way I don't have a problem with that is if you feel 100% sure now this is going to require you looking out 20 years. It's going to require you really thinking long and hard without knowing what inflation is going to do to your purchasing power. It's going to require that. And you need to think long and hard that one of you is likely to be here for a very long time yet. And you don't want to outlive your money if you don't have adequate income to take care of your spending. Everything that you do, Russ, you and your wife do right now, as you think through these things, has to be based on a consumption model. It is not based on an investment model. It is not based on a growth model. It's based on consumption and income. I am consuming this much money every month, and I have income of this. You've got to look at your consumption, and somehow you've got to look at, by using today's dollars, because it's the only thing you can do, try to think about your consumption in latter years. And are you going to have the income to sustain that? And if not, then you need to hold on to your 401k. Okay? You need to consider your 401k, because you may have to turn that into either drawing the principal as income every month, turning it into a charitable gift annuity and annuitizing it and receiving an income every month that's never going to run out. Or maybe, throwing it all into, and I'm not suggesting you do this, by the way, but throwing it all into a utility stock or some very high dividend producing stocks. So you need to consider those things. Because it's all about income for you right now. Once we leave, folks, once we leave that place where we are no longer earning income, we're retired. I mean, I'm not saying we don't have income, but we don't have the opportunities to earn income. Then we should not be thinking about accumulating wealth. Those days are over. The accumulation model that has been pounded in our heads since the very first day we started our 401k or started to work is fine. I don't have a problem with that. That's not a bad thing. But what I'm saying is, when we retire, we've got to get off it. Stop thinking about that. Accumulate what? You're not earning income. It's about increasing income. It's not about accumulation. And the sooner Americans start changing their way of thinking, they start thinking about accumulation of income and spending and paying what is going out, making sure they have enough income coming in. It is why for 25 years I've been hammering this model of accumulation. When I had my trust company and I was managing hundreds of millions of dollars, I always carved out a piece for folks that were getting near retirement for charitable gift annuities. Always. Because it's the only reliable source of income, and you're still able to do the Lord's work in doing it. So I want everybody to be thinking, and it's amazing people still haven't called the foundation and are still not doing it. Because, you know why? Because we hold so tightly to this money. We accumulated the wealth so that we might have the wealth to use as income. Then we get an opportunity to use it as income, and we can't let go of it because we love looking at that big lump sum of money. Instead of thinking that I'm going to spend that big lump sum of money anyway if I live according to statistics. It's going to be gone. So what I don't want to do is make sure I don't live beyond that, right? And don't have it as income to be drawing from. We've got to be thinking about a consumption model. So yes, Russ, roll it over, and I would think twice. And I'll go back to Russ. Let me just ask Russ if he has any questions there. Are you okay with that, Russ?
Yes, I can understand. My biggest concern was, if I do roll it over, what guarantee do I have that money doesn't get totally wiped out if the stock market or whatever the investment that it's in falls apart? That's where my concern is.
Yeah. Well, here's the thing, Russ, on that. As long as you have the money exposed to the markets in any way, shape, or form, there is no guarantees, and there never will be. Now, the only guarantee, the only thing that you can count on, again, are these, a charitable kind of situation. But the only way you get that guarantee to preserve your principal from market risk is going to be a money market account earning nothing, which frankly I don't have a problem with right now. but earning money, keep it in money market. So what I would suggest to you, and I don't want you to do that. I don't want you to put 100% of it in a money market account. But I would like, one of the things you can do is go to timothyplan.com, call Timothy Plan and open up a IRA account with Timothy, roll your money, half your money into it, and put half of your money. You got to expose some of it to the market as a hedge on the upside. And if you're planning on keeping it and keep it invested, and then the other 50 or 60%, you want to keep in a money market account. But there are no guarantees. There's never going to be any guarantees. If anybody ever tells you there's a guarantee, they're wrong. There isn't any. So the key to that is, if you want to be 100% sure, if you want to say, hey, I've got $100,000 and I want to make sure I have that $100,000 when in 10 years from now, 15 years from now, the only way you can guarantee that is to put it in a money market account and have it as cash. Now, you're gonna be losing purchasing power on that money over those 10 years because inflation is going to eat away at it. That $100,000 is not going to buy the same basket of groceries 10 years from now as it would today. And that's called purchasing power risk. And you're going to have that. You don't really have an interest rate risk because in a money market account, if interest rates start coming up, then the money market rate interest rate is going to come up. But that's your risk. It's not market risk. It's in purchasing power risk. So that's the only way you can guarantee that, Russ. And you're just going to have to decide whether you're willing to sit it in a money market account. And I would not suggest that if you don't need this money. If it's money that you just would like to see, there and you have, then I would probably take 50, 60% of it, put it in a money market for now. I may change my mind 6 months from now. We'll see how things work out and want to put more into the market. But look at a very conservative strategy, maybe with a mutual fund like Timothy Plan, where you can just, kind of forget about it for the next 10 years. So, and one of the things in that mutual fund, in the Timothy, and I've been telling people this, I really like their Israel fund. It's going to support the nation of Israel, obviously, and the companies there that are biblically responsible. And I really think that if Israel stays in existence, and if it doesn't, nothing's going to matter anyway, because we're going to be in a big-time war. But if it does stay in existence, the Israeli economy is going to do incredibly well in the next 4 or 5 years. I think in the next 2 years, they're going to be net exporters. 2 years. They don't think so. I do. I think in the next 2 years, they're going to be net exporters of natural gas. So they have an enormous amount of wealth that is going to be flowing into that economy. I think it's going to do very well. I wouldn't say put all your money in it, but if you're going into Timothy Plan, definitely have 10% or so of it allocated to the Israel fund. Anyway, thanks, Russ. I appreciate it. Let me go to John. John's calling us in Missouri. Hey, John.
Oh, hi, Dan. I had a question and a comment.
Okay.
My question is, how long will it take before they can't afford to pay the interest and default? The government.
You mean if nothing changes,
right,
or if changes. So if we continue to go like we're doing, that means spending like we're spending, and continuing to add to the debt. Or let's just say we don't add anything to the debt, and interest rates get anywhere near normal. See, this is why the Fed didn't ease yesterday, and taper yesterday, in my opinion, was because the 10-year bond is still sitting at 270, and he can't afford to see that go up anymore. That would be disastrous. If we get forget normal at 4.5%, if we get a 3.5% interest rates, let's say 3.5 to 4, the federal government now, their interest rate's going to be on the debt close to $1 trillion a year. We're going to be adding to the debt $1 trillion a year. So when you say not being able to pay it, well, I guess the way the government's going to look at it is they're going to continue to have the printing presses, and they will print another $1 trillion to pay the $1 trillion on the interest. And as they print another $1 trillion, that adds another $1 trillion to the debt, which is also going to have interest due on it. And it becomes a vicious cycle until we finally see collapse in the economy, unless we have some enormous growth spurt in the economy, which right now doesn't look too likely. So I don't know how long it's going to be, but if we continue down this road, we will certainly be going over that cliff sooner rather than later within the next two years, in my opinion. You're listening to American Family Radio Network, Financial Issues. I'm Dan Celia. 866-300-9298. We'll be back after this.